Niraj Shah. Now, it's not often that we get to say that we have hit life highs. Even more strange that it's happened in the same year that we hit decadal lows as well. It's a calendar year that has been marked by both the emotions of greed and fear, and that is what makes investing so interesting. Add to that we are close to Diwali and we have a new US president, and asset allocation would never have become so important. So to talk about all of this, as well as part two of a previous show that we did, wherein S. Naren shared his life experiences, which have taught him investing, we have the man back again to talk about, as I said, all that and more. Naren, so good having you. Thanks so much for joining in. Hope all is safe.
Yeah. Wishing all the viewers a very happy Diwali and a very happy festivities.
Yeah, it is so important to have that because we badly need it in a COVID year more. So, Naren, I would love to concentrate on the second half of this conversation about by carrying forward what we started in the first conversation a few months back, which is get some of your life experiences and try and relate them to investing as well. But first, the news is so big. We are at life highs, Naren, yet again. Did you anticipate even, at some bit of this or some bit of the nature of this pullback, and we were right at the peak of COVID-19 and maybe not at the bottom of 70,500, but maybe at 8,000, 9,000 as well? Did you anticipate this in any fashion?
Actually, no, except that the fact is that we are what I call a central bank bull market. And when you have a central bank bull market, is a very strange bull market, which none of us have experienced in our lives. So, and the advantage with central bankers is that they don't have to face elections and they have unlimited money at their disposal. Normally, when you deal with fund managers, we have limited funds at our disposal, and when we underperform, we lose money. When we outperform, we get money, etc. Whereas central bankers have no such constraints and they have unlimited money at their disposal. So I always knew that we are in a central bank bull market, and I always felt that none of us have seen a central bank bull market in our lives. And how does a central bank bull market climax? That is another thing which, again, we have never learned in our lives. So we are seeing that at this point of time, and I think that is why I think none of us could have expected in March, April that we will touch lifetime high again. And that is what has happened. So we have strange situations today where house prices are shooting up in USA and rents are going down in USA. So both are happening at the same time, and that is the power of the central bank bull market. So you have a situation where they have the ability to distort asset prices to a very, very significant extent, because you can take interest rates down to any level. And when you take interest rates down to any level, you can actually increase the valuations upward to any level. And therefore, you have a very, very different kind of markets. And that's what we are seeing at this point of time. And the more and more, when we had this entire situation where you will not have a blue wave, people felt now you are even more in a central bank bull market. And when you have a central bank bull market, it means that you can take price to earnings even higher. And that's what got the market so happy, and it has pushed up asset prices even higher. So I think how does the central bank bull market end is something none of us know. And I explained in some of the conversations that what do you do in a central bank bull market is don't say that the bull market has ended. Point number one. Point number two, respect asset allocation. Point number three, have a position in all the asset classes, equity, debt, and gold. And fourth is be disciplined and don't get leveraged and start getting drunk and say this market will last forever. These were some of the points I had mentioned in an earlier interview. And I believe those hold good even today, because all of us are seeing the first central bank bull market in our lives.
Yeah, I know you guys are carrying out this slogan. I think that Ye Diwali, Baaf Wali, or Balance Added Fund Bunch Wali. We'll talk about that, Naren. But just before that, can I ask you to hypothesize, to to an answer to the very question that you are raising, that how does a central bank-led bull market climax? Any thoughts? It may not happen that way. Just wondering.
See, basically, what has happened is $28 trillion of money has been pumped by central banks, and that is $28,000 billion or something like that. Now that $28,000 billion have gone only into assets. And when it goes into assets, it makes everyone in the world extremely happy, because it makes everyone feel richer and richer and richer and richer by the day. At some point of time in the future, in the next 1 year, 2 years, 3 years, 5 years, it will go into prices and not assets. And when it goes into prices, it goes into what you and I buy. And when it goes into what you and I buy, it becomes inflation, price inflation, and not asset inflation. When it becomes asset inflation, everyone is happy, because it makes everyone richer and richer and richer by the day. So the problem for all of us is we don't know when it moves from asset inflation to price inflation. When this $28,000 billion finally moves into price inflation instead of asset inflation, that day the day of reckoning will come. But that day of reckoning cannot be predicted by aam aadmi like Indian fund managers, because we are not at the apex of all this. We don't even know what is happening. We'll be victims, and we will be blamed because for not knowing what this is happening. And but that is the situation, because this $28,000 billion, and that is the reason you have a situation where real estate prices are zooming and rents are going down. Just imagine if it was inverted and rents were zooming and real estate prices are going down, then you have a situation where price inflation would be going up and asset inflation is going down, like what happened in 2008. Today, because rents are going down, price inflation is zooming downward and everyone is happy. On the other hand, real estate prices are going up, so again everyone is happy. So we have a very, very happy situation today, because you have asset inflation and no price inflation. So I think the problem is that all of us want to know how long this will continue, and if it continues for the next 20 years or 30 years, all of us will be very happy, because we all want only asset inflation. We don't want price inflation. If we have price inflation, then the problems come. But if we have only asset inflation, then there are no problems, because the asset prices are good for all of us, particularly the rich in US and in many parts of the world.
No, that's true. So, Naren, how does one prepare for this then? I mean, one, because you can't time it, you don't want to be, of course, not be too early in the cycle, but you never want to be the last one in the cycle, wherein you try to start preparing for an eventual turnaround only after you are in the midst of it, because that would be stupid. So what is it that, for example, you in your funds are doing right now? Are you sticking to this asset price inflation theory and right now sticking to equities largely, if you had the choice of diversification as you would have in your balanced budget funds? Or are you preparing for it in some way even right now? What is it that you would do if you are an individual investor?
See, as an individual, you have to prepare for it through asset allocation. That's very clear. You have to prepare for it by having some money in equities, some money in gold, some money in debt. And that is the reason we started this campaign this year called Ye Diwali Bap Wali campaign, because it ensures that you have some money in equity, debt and arbitrage. And that is why we started that campaign. But if you look at it as a fund manager, it is a more complicated thing, because what has happened at this point of time is you have a limited set of stocks which have gone up in the recent past or in the last 3-4 years. Our own view is that that limited set of stocks will broaden and it will go to all set of stocks. And that is our view. Before anything happens, we think it will broaden. Because why should only a narrow range of stocks move? Why can't all the dividend yield stocks move up? Why can't all the low PE stocks move up? Why can't more sectoral stocks move up? But actually, we are seeing that trend actually change. So if you looked at the last 6 months, you're seeing already that, for example, metal stocks have started to zoom. We have started to see in the last 45 days, bank stocks have started to boom. It is not that after March, small and mid caps have done badly. Small and mid caps have started to do well. So my reading is that you're going to have a broad-based market rally as this boom becomes bigger and bigger and bigger. And it is not going to be a narrow market rally, but a very broad-based rally, and it will take everything up. And that is how I look at it from the point of view of an equity investor and not a asset allocator or an individual investor. But from the point of view of an individual investor, it is very important that they practice asset allocation and not get carried away by investing only in equity. Because finally, at some point of time in the distant future or the medium future, or maybe in the next 1 year or 18 months, there will be a climax. And so if you're caught in only one asset class, you will get into trouble. And that you can't do, and you have to widen your asset class, and you have to widen your income stream that you have. And that's where we came up with this Ye Wali Diwali campaign. Because you cannot spread your assets and say, I will be only invested in equity. Although equity moves up every day, every month, and every week. And that is how we look at it from an individual perspective. And that's why this is a very interesting and difficult time to be as an investor and as a market participant. But I like the broadening of the market, the way the banks have started to go up, the way metal stocks have started to go up, the way small and mid caps have started to go up. But this part of it is enjoyable. But when the central bank bull markets climaxes and falls, there will be no place to hide. And when that happens 5 years from now, or 4 years from now, or 7 years from now, or 2 years from now, that is the problem, because they have not left us any place to hide, because you have brought down everything to such low levels in interest rates that they use the last Brahmastra in March, because they at that point of time, if you looked in March, you had a situation where gold came down, bonds came down, and equities came down. That's when they used their last Brahmastra, and they've taken it up to a very high level. And that is the situation at this point of time. But finally, we know how the problem will happen is when asset inflation gets replaced by price inflation. But again, no one is saying that it will happen in the next 1 month or 2 months or 3 months, because none of us in India will know when it will happen. Sure. We will never know when it happens, and that is the reality.
So one of the schools of thought, Naren, is also that until the consumer comes back, because the consumer is kind of amiss from the whole situation right now, that until the consumer comes back, the central banks will keep loose monetary policy on, and then the consumer will take over. And therefore, the transition, even if it's not as smooth as they make it sound to be, will not be terrible for the markets. How do you respond to that?
Maybe, but the problem is $28 trillion is not a small sum of money.
That's true.
So when they have managed to bring down, the velocity has been so low of this $28 trillion that for 10 to 12 years, you have not had price inflation. So once you bring velocity of that money high, then after that, if you want to dampen it, it would require a Walker kind of situation where you have to take interest rates up very significantly. And that is the challenge at a different point of time. Luckily, none of us can time all these things, and that is the biggest advantage that we have, and all of us have, because all of us can say we can't time it.
No, that's true. Naren, just a quick follow-up. This broadening of the rally that you're speaking about, will it happen? I mean, will it be accompanied by economic green shoots and economic growth as well? Because otherwise, it's the larger ones taking the market from the smaller ones, and therefore they are growing. For the smaller ones to be able to do well, some bit of the economic growth should happen. So do you reckon that will happen in India in the next 6 to 12 months?
Actually, we have to look at it from an India point of view. See, India has not had a monetary excesses on the lines that has happened in the other parts of the world. So when India reduced interest rates in the post-COVID environment, that has given a big boost to the economy. And if you look at the economic trends over the last 45 days, it has been very healthy. You've seen power demand go up, you've seen credit growth slightly pick up, you've seen real estate transactions go up, you have seen corporate numbers improve. So I would say that India is certainly in a better position today, and you would see that economic backdrop certainly improve at this point of time. And clearly, if you look at the earnings season this time, it has been one of the best earnings season at this point of time in years that we have watched. And it's been a very pleasant environment to see this earnings season. And it has, of course, been marked by cost cutting and indiscriminate price increases in some of the products, which has led us to a very good price profits in many areas. And but having said that, we have had one of the best earnings season at this point of time. So overall in India, we are in the threshold maybe of an economic turnaround that should help. And that's why I would say that we are going to see clear broadening of the sectors which are going to do well. And that is what we see at this point of time. Having said that, if you look at it from the sectors which have done exceptionally well over the last 10 years, all of them are trading at 50 PE and 60 PE, the sectors which have done well over the last 10 years. Do they deserve to be at 50 PE or 60 PE or 70 PE? That is where the jury is out. But sectors which have done badly for the last 10 to 12 years, I think they have many years of re-rating to happen, because they have done badly for 10 to 12 years. So why can't they go up for the next 3-4 years is the view that we have. And they have possibly only started a trend at this point of time. And I think there is a lot of scope for those sectors to improve from where they are at this point of time.
And then you played contrarian very well, and I'm not just using the term loosely that you played just for the heck of it. I'm sure when you play contrarian, there is a thesis that you put behind it. You just referred to the point that there are some sectors which have underperformed for 10 years and can do well. Where do you find this? Because I know, for example, over the last 3 years of conversations that you believed in telecom and people were not, and that has started to pay rich dividends and then it's come off a bit, but nevertheless, metals was probably one area. From here on, where do you feel that the underperformers thus far will get rewarded because their economic scenario and the business scenario prospects are also changing?
See, if you look at bulk of the sectors, like in the non-consumption areas, you'll see that the number of players have come down. If you look at the number of players in power, look at the number of players in telecom, look at the number of players in construction, number of players in capital goods. You look at, in all these areas, the number of players have come down, and therefore the competitive intensity in many of these areas have actually come down. So I think banking, once the dust settles on all this moratorium and all these things settles over the next 6 months, if you look at the 5-year view on banking, that also looks very good at this point of time, because many of the competition that NBFCs posed and various other things posed, they've also come down substantially in the last 3 years. So I think there are many sectors at this point of time. If you take metals, there are no grassroots units which are likely to come up in the next 3 years in metals. So if you look at it, you are not going to have a situation where neither the auto industry or the consumer durable industry can grow without metals. They also require metals to produce consumer durables and auto. And there are many such sectors today where for the last 10 to 12 years, there have been no returns and no new units and consolidation. So that consolidation should lead to a situation where you're going to see these companies and these sectors, after a 10-year zero return, they all should deliver at least decent returns over the next 3 years. And that is the way I look at it. And because the valuations have come down, consolidation has happened, margins have come down. So why can't these sectors re-rate, and the earnings and margins can also go up with these sectors? So that's how I look at it over the next 3 years. And globally also, all these sectors have consolidated, and many of the sectors have actually seen lower number of players and complete disinterest in these sectors over the last 10 to 12 years. So the consolidation is not just local, it is even global. And that is why I think that can happen over the next 3 years. If you look at aggregate market caps of many of these sectors globally, they are really low. So, for example, if you across these sectors globally, they have become a very, very small part of the markets globally. And that is how I see it at this point of time. That is why, despite massive runs, for example, despite improvement in these sectors like metals, they're all trading at all single-digit P's at this point of time. They're all trading below book at this point of time. And when you're trading below book after a big historic low book, I mean, how can you put up grassroots units unless they move to 2 times book or something like that? Whereas many of the consumption sectors are trading at 4 times to 10 times book. So I think there is a lot of scope in all these areas at this point of time. And as I said, this boom ends with price inflation. And they can't end with asset inflation, because if asset inflation continues forever, there can't be new sectors. So all these areas, whether it is oil, metals, all of them have to see price inflation. And it is only after those price inflation comes that these sectors will see further. So that's why I think from a cyclical point of view also, they are in good situation, because finally the asset inflation will lead to price inflation. And when that price inflation happens, like what happened between 2002 and 7, you're going to see a lot of profits in these sectors. That's how I look at it at this point.
Got it. Naren, any implications to your mind of the change in presidency in the US?
See, clearly, I think we are going to see a situation where dollar will continue to weaken, which is very good for emerging markets. Emerging markets have not seen a lot of flows over a long period of time. So we are going to see emerging market flows. We have seen a lot of problems into emerging market flows and a strong dollar for a significant part of the 2008 to 2019 period. So I think overall it is a healthy development for emerging markets. While the emerging market quality stocks are not cheap, I think emerging market, the value stocks and other stocks are belonging to materials, energy, and various other sectors. They've got so derated. I think there is a big boom that can happen like 2002 to 7 in many of these sectors, which can happen. So overall, it's a positive development, and I don't think that the global asset allocator is overweight emerging market. I think they are underweight emerging markets, and that is the other reason why I think they can all move money into emerging markets. And that will be another positive to happen in a depreciating dollar environment. So overall, it's a reasonably healthy environment, and that's what has been seen in the last 1 week also. And the only challenge, as I mentioned, is that as and when price inflation comes, global interest rates have to go up, and that is the risk. But that's not a near-term risk. That is as and when it plays out.
Agreed. No, but a lot of theories about if Joe Biden, for example, brings in Iran into the global fold, then it might be negative oil, or he might ease restrictions on visas and that might be positive IT, or he might spend on infrastructure and that will be positive for global metals. Are you trying to hypothesize on any of these because of a Joe Biden presidency?
Yeah, I think overall it is positive across emerging markets for various reasons that you mentioned. And there can be a clean energy trade, there can be benefit to Iran, there can be benefit due to H-1B visas, there can be benefit due to so much of geopolitical stress has also been created due to various tweets. So all these things can also happen over the next 2 to 3 years, which can also lead to a lot of benefits to emerging markets. Overall, the environment is healthy at this point of time. The debate and the problems are only coming out of valuations. It is not coming out of trends. It is not coming out of trends.
That's my headline, Naren. That's my headline for the interaction. Okay, last question or last couple of questions. Naren, the last time that we spoke, you spoke about the key things that you've learned and which you tried to implement in your investing theory or investing sphere. Now, one of them would be asset allocation, and you've spoken about that on this show already. Anything else that strikes to you as material when we look at all that you've learned in your decades of learning and trying to implement them currently?
Look at this year, no? Actually, March 2020 presented such an opportunity. Let's look at it. How many people made use of that opportunity in March 2020? how many people saw it as a problem and how many people saw it as an opportunity. If you look at it, the reason why we started this campaign called Ye Diwali BAF Wali campaign is because in that fund BAF, we could invest almost 5,000 crores in March. And a fund which could invest 5,000 crores of equity in March, and this is published data, that we could invest 5 to 6,000 crores between February and March in equity, is the kind of fund which makes a lot of sense, because in panic you could invest 5 to 6,000 crores in equity. And that is the beauty of the entire thing, that equity markets go through panics, they go through fear, they go through greed, they go through all these kind of things. And that is the beauty of this entire thing, that, in 2013, people got consumed in real estate. In March this year, people got consumed in fear in equity. And the way things have shaped up today, that, on the eve of Diwali, if you go across many of the places, and there are people who have stopped worrying about COVID. And that is the beauty, that is the worry actually, from a government point of view, that people have stopped worrying about COVID. And that is the challenge at this point of time. You can see the number of cases increasing in many of the Western countries. And that is the challenge in India. It's been coming down, but in the world, it's been going up. So I would say that, everyone believes that knowledge is everything in investing, but actually knowledge is not investing is everything. It is emotions and balance and the ability to think rationally and implement asset allocation, which is interesting. So if you look at the BAF as a category, why did we create this category? Because in 2015, when China problem happened, we could buy. After demon market corrected irrationally, we got an opportunity to buy. After ILFS, the market corrected irrationally, we got an opportunity to buy. When COVID happened, we got an opportunity to buy. So, we felt that, any strategy which involves buying in panic and selling when the markets keep going up, it gives investors a good investment experience. And if they could do it themselves, that if they could gather the guts to buy in March, if they could gather the guts when ILFS defaulted, they also could have made money. It's not that they can't do it on their own. It is just that they need that emotional balance to buy when China gets into trouble in 2015, or when Lemon is declared bankrupt, or when COVID happens. That's all that they need. So we say that if you can do it yourself, you can do it yourself, no problem. But otherwise, we create a strategy which results in it. And that is what, everyone thinks that every data comes out of knowledge. It doesn't come out of knowledge. It comes out of your ability to handle emotions. Is real estate a superior asset class today than 2013? Certainly, because you've had 7 down years or 7 year flat years of real estate movement. So on the other hand, today people invest in debt thinking they'll get double-digit returns like what people have got by investing in 2017. Now debt is an asset class, is to be invested for capital protection. But to get double-digit returns on debt is difficult from here. On the other hand, a product like BAF can make money out of volatility, particularly when that central bank bull market climaxes. And that is the advantage of that kind of strategy. And that is what we tell people when SEBI says equity market carries risk, mutual funds carry risk, past is not equal to future. These are all very great statements because markets are like that. And that's the beauty. And that's what I basically believe in. And that is the challenge, that after an event, sometimes the markets is much safer than before the event. And that is the beauty for most investors.
Yeah, after the event, maybe the market is a bit safer. But Naren, this was lovely talking to you today. Thank you. Lots of wonderful anecdotes and some wonderful thoughts as well. Thank you so much.
Thank you.
Wish you and yours a very happy Diwali and a prosperous New Year.
Yeah, let's all be very careful. COVID is not gone. As you have shown, we have gone back to more than 1 lakh cases there. So I think let's enjoy Diwali, but let's be careful. Let's not indulge in very unsafe behavior. Let's be very careful as far as COVID is concerned. Maybe burst lesser crackers because it's been told to be negative for COVID. But let's enjoy Diwali. Nevertheless, I think in March we never expected that we'll have such an enjoyable Diwali from a market perspective. So let's enjoy Diwali. Thank you.
Yeah, and stay safe, more importantly. But Naren, thanks for joining in today. And viewers, thanks for tuning into this edition of The Talking Point.